Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. On this episode, we're going to be talking about the uncertainties in the markets, which are clearly exceptionally important right now, as we are recording on June 10th of 2025, quite a tumultuous year, with someone who has been through and experienced a lot of tumultuous investments in her life, Rupal Bhansali. Rupal is the CEO and CIO of Double Duty Money Management. Previously, she was CIO of Ariel Investments. Prior to that, she worked at McKay Shields, Oppenheimer, and Soros Fund Management in various portfolio management roles. Her degrees are from the University of Mumbai and the University of Rochester. So, welcome to the podcast, Rupal.
Thank you for having me.
Well, so I'm exceptionally interested in hearing about how, in your current role and in your past roles, you looked at the uncertainties that are inherent in all markets.
So, Rob, it's certainly the question for the day, isn't it? Given that markets, we are always told, fret about uncertainty. Frankly, I don't think it's that what gets you into trouble, even though I know that people think uncertainty is the worst risk of all and the most disconcerting. I think it's certainty that can be the biggest risk. And what I mean by that is, I think you know I'm a non-consensus investor, so allow me to unpack some very contrarian and counterintuitive ideas here on your podcast. I think it's certainty that ain't so that gets you into trouble. If you think about the GFC, people thought they were buying AAA paper, and it ended up being CCC paper. It's with certainty they thought they were buying very blue chip, high quality, no default risk kind of paper, and it turned out to be the opposite. And I think that's really what got us all into trouble, if we were certain about something that didn't play out. And I think while there is a lot of uncertainty in the markets, there are certain things that people were very certain about just not too long ago, like US exceptionalism and how the US markets are the best place to be. And of course, you've seen what's happened at the start of the year. People are seriously questioning about the sustainability of the US budget system, governance system, and many, many other questions that, of course, have come to the fore. And I think that this is exactly the kind of thing that people should worry about. It's things that we know to be so, or we believe to be so, that don't prove out to be so. So the whole Mark Twain quote, which I'm, of course, jumbling up a lot here, but it's not what you know, it's what you know that ain't so that gets you into trouble. And I think that's the mantra for 2025 and looking ahead.
Well, just to unpack this a little bit, there was this thing that's back in school we called the risk-free rate.
Exactly.
That apparently won't so for either. Well, one of the areas that a lot of people are talking about in terms of uncertainty right now are the private markets. Now, the private markets have been all of the hallmarks of things that might go down. There's a massive amount of assets moved into them in the last 2.5 years. The private markets were actually the saviors of some high-yield issuers when that market froze a couple of weeks ago. They moved over to the private market, and the private market handled it just fine. So if the private markets are Superman, what is their kryptonite?
People underestimate the effect of leverage as a source of amplification. So what happened, I would say, in the last 10, 15 years, as leverage or borrowing was practically cost-free, not to mention risk-free, that this industry, both private credit and private equity, levered up a lot. In fact, their business model, their financial model is their business model, which is levering up. And I think that is their kryptonite, because that very leverage that amplified the returns can amplify the risk of complete loss. So I am surprised that people don't call private credit junk bonds, because they frankly are. And I'm surprised that people don't call private equity junk equity, because that's what it is. By any metric, if you research those companies and you looked at their balance sheets, they're extremely levered. And I think in the good times that turbocharge the returns of these investors, the opposite can happen in the decade ahead. And I think that's the kryptonite, the leverage. A lot of people, I remember when there was a correction in 2022, people said, they were bracing themselves for the markdowns in the private credit, private equity markets, which never really came to pass. And it's not just, and I think a lot of people thought, will the markdowns be 10%, 20%, some number thereof. I think the number people could think about is, could it be 100%? Because remember, when you have that much leverage, your equity can get wiped out. This is why Freddie and Fannie went under. We forget, it was a leverage. It's why Silicon Valley Bank. It's the leverage inherent in these models. It's not that they don't have good franchises or good businesses. Both Freddie and Fannie did. I mean, just as Silicon Valley Bank did. But it's the balance sheet that got them into trouble. And I think that's what people are overlooking, so to speak. And again, it's a certainty. People assume that the returns from that asset class are going to be double digits because that's what they've been. Imagine, instead of them offering you returns, they offer you risk.
Well, let me unpack that for a second because, of course, Fannie and Freddie were semi-governmental.
That's right.
And they had an appointed...
They had a backstop.
They had an appointed successor, HFHA, right? So private
but
credit
I mean,
doesn't
the
have that.
equity investors
Right.
got wiped out.
Yes, the equity investors.
I think that's the difference. In this example of private equity and private credit, it's all private investors, whether it's in the bonds or in the equity. And I would just say buyer beware.
Right. So one of the things that is often hard to understand is the actual sort of multiple that we're talking about here, because the leverage does amplify everything.
That's
good,
right.
bad, or otherwise.
Exactly.
Yeah. So,
and in the good times, it is a source of return. In the tough times, which is, I think, what's ahead, it's a source of risk.
It seems obvious that one of the issues that a lot of these companies are facing right now is their balance sheets simply aren't built for higher debt service.
Exactly. Including our governments, if I may add.
Yeah, well, that's for sure. Although governments can do things like print money.
Exactly.
Private companies can't do that. So,
for sure.
But do you see other risks in the private credit market other than just that their models aren't set for higher interest rates?
There's also the risk that, underwriting is a very important skill set when you're lending money. And so is restructuring. When the loan does go south, do you have the bandwidth, the resources, the capability to restructure the loan, to rework, work with the company to make sure that the finances improve? And I think it's easy to write the check and to underwrite based on some numbers. But then when the real hard work begins is when the loan goes south. Banks used to have those departments. They used to have a whole team of people. They used to have separation of duty between the person who underwrote the loan versus the person who would make it, get paid back. I think that the private credit industry is not geared up along those lines. And so I would say that that's the real risk, that instead of working out these loans, companies just fail when they can't repay them. And there is no reworking, restructuring potential, again, because the lenders don't have the bandwidth. So I think these are the real world considerations, that the rubber meets the road when things go south.
Yeah, and just anyone listening to this podcast who had some experience with working out portfolios back in 2010 and 11, 12, I believe you might be in demand here soon.
Exactly.
Now, there's also this question about in the market about how many people who are in the market actually lived through the last tumultuous market. And you've had the benefit of experiencing a few of them. So how do you, from a philosophical perspective and a strategic perspective, approach a tumultuous market that some people here who maybe haven't had the experience might learn from?
You have to approach investing from both an analytical perspective and therefore intellectually analyze what's going on, but also from a behavioral perspective, anticipating how others might react to something. And both can be a source of opportunity, or you can become a victim, to those two attributes. So I think you're absolutely right. One of the things that I almost joke with my clients is that when you look at us, we actually have a track record as opposed to a trend record, because what's been working in the last 10 years, 12 years, is just one kind of theme, which is risk on and momentum and growth and tech. And I think you need to live through very different environments to really know whether your skill set is versatile enough to handle that diversity of outcomes, which I think is what's lies ahead. So I have been through the Asian crisis. I have been through the tech bubble burst. I have been through 9/11. I've been through the European sovereign crisis, the pigs, in 2012. Then I've been through 2016, mini recession, which people have forgotten about, but it existed. The 2018 taper tantrum, the 2020 Q1 COVID crash, the more recent April 2025 tariff war. Yep. And so, yes, I witnessed, the Japanese market burst in the 90s, because that's kind of when I entered this industry. So I think when you've been through very different cycles, back in the day, people forget, the two most favorite industries to invest in the 90s was pharmaceuticals and insurance. I mean, who remembers that? We don't even think about those two industries as being sexy, but insurance was a place to be till they all lost their shirts, investing in the stock markets in that bubble. And then the government, the regulators got their act together and required them to put up more capital, and they swore off equities. And then, of course, you had the biggest bull market ever. And now they're sort of trying to come in through the back door, in my view, through things like private credit, missing out on those juicy returns. A little too little too late, in my view. But anyway, I think you're right. Look, when we've witnessed so many different things, you develop an antenna for what are the signs? What are the landmines? That you want to avoid. I would say that the two things that we always look at in terms of foreshadowing risk is the credit markets. Whenever credit growth is buoyant, and it certainly has been in this country, we call it a fiscal stimulus or a deficit. It's all credit. It's all debt. That's always a lead indicator of trouble down the road. And then the other thing that we look for is credit spreads. Frankly, credit spreads have not widened out as much as you would expect. If people were really worried about a recession or really worried about, the tariff, inflation, all those things, you would have seen a greater deterioration. So far, the deterioration we've seen is in the 10-year bond, certain 30-year bond rates and so on in different countries. But if you look at the credit spreads, which to me is a true marker of credit investors feeling worried about the economic environment, so far it's been rather benign, actually. And I think that's a source of comfort. Now, it could blow out very quickly, and I've been through many of those. But I think that's sort of the push and pull of this market, that certain things like VIX, blowing out for a few days, but then sort of coming back to normalcy, and certainly with the rates. So I think we are heading towards an environment where volatility is greater, but so far it has not materialized. The way to prepare for this is what we've always done. We didn't know COVID was coming, but our portfolio is insulated very well on the downside, because when we do our research, we always do a pre-mortem, which is what is a worst case scenario for this company?
Okay.
If things go wrong, how wrong can they, what really gets hurt? Mm-hmm. One of the proactive pieces of analysis we had done is companies, we break up their cost structure, not just in terms of, their total costs, but what are fixed costs versus variable costs.
Okay.
If you didn't know the answer to that, COVID caught you completely off guard in terms of making decisions.
Right.
Because revenues were going to plummet.
Right.
There was a absolute shrinkage of economic activity before, of course, the stimulus came along, and the companies with fixed costs would get hurt the most. So two things that we look at most is financial leverage gets into trouble very quickly, and operating leverage. People forget the operating leverage part. And high fixed costs, tend to do that to you. So this is something that we are doing a lot of work on as we speak, because in a recession, revenues fall to different degrees for different companies. But if you have higher fixed costs, your earnings are going to fall much faster. That's where I focus my attention on.
Interesting. So when you think about the risks provided by too much financial leverage, I was just thinking about when there might have been a good example of that in the past. I was thinking about, going back, Enron.
That's right.
That was way over levered. Dot bust. They were severely financially levered. Mm-hmm. GFC. Are there other ones that I'm not thinking of that were...
Private equity.
Oh, yeah. Okay. Right.
The hidden leverage
that
people don't see. But, on average, a deal is, 6 to 7 times debt EBITDA. If you were a listed company, that's squarely in the CCC category of junk. It's the lowest of the lowest. Right. They're not viewed as such, and that's the problem. People think of them as just giving the high returns. They do not see the high risk that you're taking to generate those returns.
Well, as a person who used to work for a ratings agency, I'm sort of obligated to tell you, even for the rest of my life, that ratings are based on other things other than just EBITDA.
Yes, I know. But it's just a proxy measure of at least understanding the degree of leverage. You know, it's not on the cusp. It's like way out there.
Yeah, it is. Well, this has been exceptionally sobering, shall we say? so thank you for being here, Rupal.
Well, thank you for having me, Rob. And I think that one of the things that at Double Duty, our tagline is that we manage risks as well as returns.
Right.
I think money managers think that their only job is to manage returns. Frankly, if you don't manage risks, you cannot manage returns. So that's a thought I would leave you with.
Exceptionally well said. So Rupal's out there a lot. You can look her up at Double Duty Money Management. There are lots of places you can find her on the internet, on podcasts, etc. So find her if you like what she said here, want to hear more. Find her, you'll find her. Until next time, I'm Rob Rowan, and this has been Compound Insights.